start with our today's topic. Today we are going to split our discussion on two separate things. Number one will be the rule-based trading, and second thing will be discussions upon the stocks which we normally trade in. Rule-based trading, this is nothing new, and these have been been discussed in our previous sessions. And I have just formulated it together to see how we can discuss it together, and we can start following this. These are the things which we have already been discussing it for a very very long time. Okay, guys, you can ask me questions in between if you want. I will be going relatively quicker on this because I believe that most of these things you guys already know. It will be just a quick refresher to the points which we have already been discussing in our previous sessions. So let's start with this. So first of all, like, you need to identify yourself as an investor or a trader. But the investor, I mean, you see yourself a long-term investor, like over a period of like 6 months, or like even 6 months is not a long term. It goes in terms of years. If you are a long-term investor, then your trading strategies will be different. Or if you are a trader, by trader I mean you are an intraday trader or you are a swing trader, then your trading strategies will be of course different. So and the time frames on which you will look the technical charts will also be different. So you need to define yourself. In this session we are not going to see what are the differences between these investors and the traders and what should be the trading strategies. Rather, we are defining some set of rules which anyone has to follow in order to be a disciplined trader or investor. So number one, you need to identify yourself. Ask yourself a question: you are an investor or you are a trader. Next, set your rules for picking up stocks. You need to have your own rules. In our group, mostly, which I see, like, we are dealing with the stocks which are not more than like $20 or so. On most of the time, it is less than $1. So I can say like a penny stocks. It all depends upon you. If you are comfortable doing trading in the penny stocks, go for it. If you are not, then stay away from that. For me personally, I don't like to trade in penny stocks. Penny stocks for me, like anything below $1, I am not comfortable in trading in that. But we have all seen, like, we have a strong growth or spikes in some penny stocks. Like in a day, they are going 30% or 40% or even more. And on the other side also, they're falling by 30-40% too. So it depends upon you. Like, you have to set your rule, like you will deal in penny stock or you will not deal in penny stock. How you can answer this is, like, see your trading history. If you are making good money in penny stocks, okay, it means like penny stocks suits your trading strategy and you're good at dealing with those. If you are not making money in the penny stocks and you're losing them, then you need to see where you are better off. If you are good in dealing with some other stocks which are like not penny stocks, then focus on that rather than focus on the penny stocks. So this is just a rule to ask yourself, and then set your rule. And then always use stop loss. If you use a stop loss, maybe you will lose a profit and make a loss, but you will not lose your capital. If you lose your capital, you are out of the game. If you need to win the game, you have to be in the game. So you in order to be in the game, you need to have capital. If you lose all your capital, then or most part of it, then it's not called efficient trading. You are like maybe trying to prevent a small portion of a loss, but in the end you ended up losing your capital as well. So always use a stop loss and exit the trade if it is going against your rules. And your rules may be like, you can set a stop loss below a support level, or you can say like, if I lose, let's say for example $50. If you're intratrader, you entered in one trade and you said, okay, if I lose more than $50 in this trade, I will exit. So how you will define this $50? It depends on it comes from your own risk appetite and your own risk management. And as a thumb of rule, people say like, if you lose more than 5% or 7% in that stock, your loss is like 7%, exit the trade. And some people like argue that if you have already made $100 in intraday trading on that day, you can afford a risk of losing $100. So at the end of the day, you have lost nothing and you have not gained anything though. So it all depends upon your trading strategy. 7% loss, or equivalent to the profit you have made on that day, or below a support level. So some basis points below your support level, you can set your stop loss. But the main important thing is, uh, you need to set a stop loss, and then you abide by your own rules. The next, always remember, trend is your friend. Never go against a trend. If the trend is rising, it is a rising trend, so then don't short the market. Don't sell in the time when it is rising and then you hope to buy it at the lower price. It will not work. So never go against the trend. If it's a rising trend, you need to enter into long position rather than a short position. Long position means you need to make a buy. You don't need to make a sell and then you hope to buy it at a lower price. It will not work, because if the trend is an upward trend, and the trend you need to identify as a whole from the market perspective as a whole, like market is going up, the index is shooting up, and then you need to see it, your own stock which you are interested in, on the daily time frame, on the monthly and the weekly, and then you choose when you choose the entry point where to enter. And never try to catch a falling knife. What does that mean? This is, guys, now very interesting. You see a stock falling down. Okay, you bought it, for example, at $20, and you saw now it's trading at $15. You will buy more. Okay, I will average out. That's your concept. Then it will fall more, $13. You will buy more. Okay, oh yeah, I'm averaging out. I'm good. Actually, you are trying to catch a falling knife. It is falling again, 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 and again. And you, every time you're buying, and you end up, oh, now I don't have anything to buy further. I'm maxed out. So this is actually a concept of falling knife. If you will try to catch a falling knife, obviously you will hurt yourself. So what should you do? You should wait until the stock has already fallen down and has changed its trend. Change in trends means it have all now started moving up. This is the point where you can enter. Give the stock a space, give the stock a time to fall down, and where all the selling is exhausted. When all the selling exhausts, now this is the time when there are no more sellers in the market. At this point of time, now buyers will come in and they will start purchasing. If you are purchasing when it is going down, obviously you are trying to average out your price, but that not be a good option to do this at this point of time when the stock is in a downward trend and has not yet stopped falling down. So this is very important point which I see in our group. Most of the guys we are doing, like we are buying some stock, then it is falling down, we are averaging out, then it has fallen down more. Then we think, okay, do we need to buy more to average out? So it will not work this way. Otherwise you will end up blowing up your whole account, and your most of the portfolio will be comprised of that particular stock which is in downward, because you have bought more and more and more, and stock it is in downward, and you're like 30% portfolio comprises of that stock. So it will, in the long run, will not help you. And the most important thing, another important point, define your own set of rules and never go against them. So once you have decided a rule that you will not enter a penny stock, don't enter it. Or any other stock, any other rule you have defined, like I will go by this rule, then stick to that rule no matter what happens. If you think that going against your rule at this time will give you some money, don't do that, because at this time, by doing so, you will not be disciplined, and you will not be going by your rules. And in this case, other worst thing can happen, like you are going against your rule and you are thinking that you will make money, but you ended up losing money. So it will not be a wise idea to break your own rules. Set your rules and be disciplined in trading. It will come over a passage of time when you are like not a beginner anymore. So you will end up making good money if you define your good set of rules and you stick to that. And set your targets, exit the trade once the target is achieved. This is also very important. You have set a target that you will sell this stock which you bought at $10. You're going to sell it at $13. Once your target is achieved, then you must exit the trade. Don't wait for one more dollar. You wait for one more dollar, you do greed, and then the stock from 13 falls back to 11. Then you lost $2 which you should have earned if you have sold it in a timely manner based on your own rules. Here we are not discussing how to set your target. That's a separate topic. Okay. But what we are focusing on is, if you have already set a target, then don't fall prey to greed and uh, realize that profit and come out of the trade and be happy with whatever you have earned. If from 13 it goes further up to 15, don't think that you have lost $2. You have not lost $2. You have actually gained $3 in this trade. So be happy with what you have earned and don't fall prey to greed, and always control your emotions. Emotion sets in when you are focusing on screen. rather than focusing on the technical analysis and the fundamental analysis. You opened your screen in the morning and you saw some stock going up. You got your emotions coming in, and you thought, okay, this will be a good trade. Let me enter it, and I will make a good money out of it. But you never saw the chart. You never saw the technical chart, or you never saw the fundamental analysis of that stock, and you felt very happy to see the stock price moving up and up and up, and you thought, okay, let's make money out of it, and you entered blindly and ended up losing money. So that happened only because of your emotions. So you need to control emotions. Like yesterday, what happened in the last trading session, for last two trading sessions, the phase drive from $10 to $15, and the next day from $15 to $18. Many of the traders would have entered in it without doing the particular research. Maybe the fundamental analysis would have been done, it was based on some news or something going on. But if you fail to see the technical analysis of that chart, how it is behaving on that day, and from $18, if you enter, it's not a problem to enter in that stock. But then you have to be very disciplined and set your stop loss. From $18, when it started falling down, it fell drastically to 12, and then went up again to 15, 16, and then again falling down. So that was a dead cat bounce. I will discuss with this what the dead cat bounce is. So it happens. So you need to identify your targets. Once the target is achieved, exit the trade, and always control your emotions. Emotions will say to enter in a trade, or emotion will say, okay, let's exit the trade. But you don't need to make your decisions based on your emotions, rather than based on your fundamental and technical analysis, and based on your own set of rules. So follow those rules, don't follow your emotions. Okay, I know this is very hard to say, very hard to practice, and easy to say, but believe me, you have to do this in order to be a successful trader. And don't do panic selling. Sometimes is going down, 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 and you get in panic and you sell the stock, and after you sold it, it starts going up. So you will say, what I did, I should have waited more. So how to overcome this thing? When you don't know when the stock will start moving up. So this thing, you need to see the support levels and the resistance levels. So you need to do some technical study before you enter the trade or you exit the trade. But avoid panic selling. You must make up your mind, if it goes down, this is the level till which it will go down. And then if it goes further down the support level, here is a point where my stop loss will come in, and I will exit the trade. So there is no need to panic, because you knew it will go down, and there is a certain level it will go down, and from that it will rebound. So you need to be relaxed. So if you do a panic selling, then you will end up losing your money. So guys, this was a brief introduction of rules based trading, and most of the rules we already knew and we have been practicing. It was a refresher for those points, and few points, like, I think that might be new and interesting and will be very helpful for you guys to practice on further.